Hi everyone, it's Sean from Pohl's Markets again. We've got Dr. Manny Pohl from ECP, the Portfolio Manager and Managing Director. Today we're going to talk about two of his funds, mainly the Flagship and the Global Masters Fund. But I'd just like to welcome Manny now and say thank you for coming.
Pleasure, Sean. Excuse my croaky voice, but it's always a pleasure talking to you and hopefully all of your investors. And I hope I can make some sense and get some interest for you and for us.
That's fantastic. What we might just start off with quickly is that, Manny, you're recognised for investing in quality growth companies or companies that are very good. Do you see yourself as a growth investor or as an investor who's hunting quality businesses?
So, I mean, that gets to the heart of what we do here. And you've got to start at any manager needs to have an investment philosophy that they follow. And if you're a quant guy or you know mathematically orientated, you need to explain exactly what you do. And here in this business, everybody that's involved at ECP, we believe that the economics of the business drive long-term investment returns. So 99% of what we do here is analyzing the businesses from a perspective of a business owner. So we look at the fundamentals relating to the business. What does the balance sheet look like? What does the market look like? Is it big enough for these people to expand in? Because the last thing we need is for the company's profit, turnover, all metrics related to the business to be driven by the general performance of the economy. And that's not something that we want to be in. So we want to be in companies that can outgrow or grow at a faster rate than the competitors, what's actually happening in their space, because they've got a better business model or they've got a better product, et cetera, et cetera. So to answer your question directly, we're into businesses that are able to grow their economic footprint, and we want to see that happen over a period of time.
Okay, thank you. The last 12 months has been difficult for the markets, particularly growth companies. Were you surprised how long the market fall has been, the recent fall?
Look, I wouldn't say I've been surprised, no. The real fall in the equity or the shares that we're in has been in the period from December to June, end of June. It was a 6-month period where we saw a massive contraction in the valuations of these businesses, driven by, at the end of it, the interest rate, the threat of interest rate increases, as well as the war in Ukraine, which caused supply lines, et cetera, to be disturbed. We'd seen faster falls. I mean, some of the companies that we watch in 87 fell quicker and faster than what we've seen this time around. So no, I wasn't that surprised. What has surprised me is the extent to which we've seen not necessarily a rebound, but an improvement in the valuations in July and into the beginning of August. That's happened that's the piece that happened quicker than I thought. I didn't think we would see the rebound occur in July like we saw, where stocks are up 8, 10, 15% in the course of the month. I thought that would take a little longer than that to occur, but certainly delighted that it's happened.
Okay, great. We've just come through majority of ASX reporting season. With regards to growth stocks, how did you think they went? Were there any surprises that you could see?
Yeah, the surprise that what surprised me was the fact that companies that reported sort of in line with what we and other fund managers or analysts in the market were expecting, I would have expected would have been hammered on the day. That if you sort of put your results were in line with what the consensus figures were, you would be down 2, 5, whatever on the day. That didn't happen. We saw those stocks either retain or slightly up. If you beat the consensus views, the stocks were up quite dramatically. So I was really surprised at that. What it said to me is that this pessimism that's occurred over the past 6 months, investors were thinking it was overdone. And companies that were reporting it, what was deemed to be acceptable, were fine. I mean, fortunately for us, we didn't have any that came out with shocking results and got hammered on the day. But the bulk of them either up really handsomely or they were up a couple of percent, and that did surprise me.
Within the Global Masters LIC, you have exposed to US stocks through the Berkshire Hathaway position and also a sizable exposure to UK growth companies. Can you give us any comments on global markets and your personal outlook on the markets?
Yeah, I mean, I don't like to not answer the question that you've asked, but we don't follow macro trends at all. It's all about the fundamentals of the businesses that we run, and the portfolio construction is based on the outlook for those businesses in terms of the return we think we're going to get. The only time we have a kind of a macro overlay is when we're deciding whether we're going to go into companies in the global portfolio or not. And for that overlay, we use a global think tank called the Institute for Positive Peace, and they rank companies according to their microeconomic fundamentals and the rule of law, et cetera, et cetera. That's the only time we have a macro overlay. Other than that, it's all bottom up, the metrics relating to that business and what we think we're going to make out of it, and that's how the portfolio construction works. In terms of the UK, I mean, obviously we've got to take into account the political shenanigans that are going on. And when you get the prime minister rolled like Boris was rolled, you've got to think about downweighting that particular market in favor of others because they don't have that kind of political nonsense that's going on. So that's the instance where we do downweight a particular country versus other countries. We use that Institute of Peace as I've suggested, but really the underlying holdings in the portfolio are driven by the amount of money we believe we're going to make out of them on a 5-year view based on an internal rate of return that we calculate. And then we can compare it to the bond market in that country. And if we get a premium for owning equities, which are deemed to be a more risky asset class, we'd put it in or we wouldn't. So it's not really a macro overlay other than the sense that I've just spoken about.
I know you've just said you're not a macro manager, but with the drought in China, the tension the war with Russia, Ukraine, you've got high interest or high inflation, which is leading to higher interest rates. Do you think it is a good time to take a position in the market at the moment, or should we be very selective?
Sean, yeah, I mean, when I say we're not a macro manager, that's in terms of how we construct the portfolio and what we pick to go in there. We're from the bottom up. But obviously when investors like yours are looking to get into a manager like ourselves, particularly because of the massive volatility in growth stocks where you go from multiples of 50, 60, and in the US market like 100 times, and then they get wound back to multiples of 20, 30, and growth companies like PayPal that are 70% down. Clearly, that's where the macro consideration comes into play, is because these growth assets get hammered and they become what one would say cheap at that point in time. So that's where you would play the macro considerations. And to your investors, in people like us, you would want to pick us at the sort of not the worst possible time, but at a time where everybody is heading for the hills. People are worried about all these macro events. The discount rates go up, the valuations come dramatically down, and provided the manager is investing in quality assets, that's the time to buy them. You obviously don't want to buy them if all of the growth investments that we're holding are these back of the matchbox IT companies that are based on burn rates and no real customers, but just some idea somebody's got, and he's got a website that he thinks is going to generate these people. Those sort of things, don't touch them like a barge pole. But if they've got a fundamental business that is sound, solid balance sheet, they've got customers, they're growing their earnings, they're growing their cash flow, this is the time to buy them when you get these macro factors coming to play, because the valuations are just down way further than what they would ever be. And you get the uplift of the discount to the NAV in the LICs. So we trade at a bigger discount when these sort of macro events happen. You're getting a really quality underlying asset at a much bigger discount, and that's the time to buy them.
Well, thanks so much for your time today, Dr. Pohl. I hope to see you soon, and look forward to catching up next time.
Yeah, thank you. And I hope your high net worth individuals find interesting what I have to say. I spoke recently at a conference on business and the things that we look for. And most of the high net worth people have made their money through being in business themselves. And our approach always resonates with them because it's based on the fundamentals of the business, and we don't own it. as we wouldn't if you were buying, the corner store. If it didn't stack up from a business perspective, we wouldn't own it, and that brings it. So yeah, hopefully we get some of your clients coming on board and investing in our LIC, because they will then be buying an approach that's based on business fundamentals and not necessarily just macro plays or over and underweights versus the market. It's purely based on the business fundamentals themselves.
One thing I might just add at the last minute, the biggest shareholder in the LICs, that's personal managers in the fund, aren't they?
Yeah, that's right. That's us. It shows up as City because that's the custodian that we use for our business. But it's essentially myself and the guys that are in the business. We own the lion's share of it.
Yep. So you invest alongside people, not against them.
Oh, yeah. And in fact, to answer your question in a more direct way, our policy here at ECP is that we do not allow the analysts in the business to own any other stocks other than what we have in the portfolios. So if we are buying Rio for the portfolio, our analysts cannot buy BHP. They have to, in their own portfolios, because we have their own super fund and their trust, etc., on our system, so that our compliance people can monitor what they're doing. But all of the assets that they own, or the stocks that they own, have to be what are in our portfolio. Otherwise, we're speaking with forked tongue, and we can't have 2/3 of our portfolio in these stocks, and then they've got them in some other stock. So we don't even allow that. If I find out that somebody was trading some other stock other than what we had in the portfolio, you wouldn't be with us for too long.
That's terrific. It's just like when we're looking for small cap stocks, we're looking at what directors are doing, how much skin they have in the game. So you sort of emulate that with your own staff and managers investing.
Yeah. I mean, if we, excuse me getting sort of basic, but if we buggered up our stock selection and our portfolio construction and it negatively affected our clients in a serious way, my hip pocket would be absolutely belted. So yeah, I mean, we rise or fall by our own cooking, and we've done really well over the long term, and so have our clients, and that's the only way to do it. We can't have guys here betting on other things as opposed to what we're doing for our clients. It's just not on.
Fantastic. Well, thanks again for your time, Manny. I look forward to speaking to you next time.
Yeah, no, my pleasure, and thanks for having me. And if you and any of your investors want to follow up and particular questions that they might feed through to yourself, Sean, just give me a call. Happy to jump on a call such as this and talk a bit more about it.
Okay, fantastic.